Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. If you're curious as to whether or not you should be considering adding alternative investments to your existing portfolio, you're not going to want to miss today's episode. We're going to address the three questions you should ask before investing in alternative investments. Thank you for taking time to check us out. And if you enjoy this episode, please consider liking this video and subscribing to our YouTube channel. Our special guest today is none other than Pat Bowen, President of One Capital Management. Among Pat's many responsibilities, he has spent a significant amount of time on behalf of One Capital Management clients exploring the alternative investment space. And with that being the case, I could not think of a better guest to address the three questions you should ask before investing in alternative investments. Pat, thanks a lot for making time for us today. Really appreciate it.
Wayne, thanks for having me on the show.
Appreciate it. And we're gonna cover a lot of ground here, but I think this, again, I would say that it's been for about 5 years now or so you've been exploring the alternative investment space. And while you may not be quote unquote an expert, I would suspect that you would at least be willing to describe yourself as well informed on the topic at this point, I would imagine.
Well, at this point, I would like to think that people would believe that I'm well educated on this. It goes back even further than just the last 6 years, 20 something years, having literally sat on the sidelines of the world of private investments and waiting for, frankly, in our view, the best way to bring those assets to bear for our clients, what we think of as simple and elegant way. They had to be in a portfolio, in a vehicle, a fund that allowed for simplicity, allowed for more liquidity, allowed for a simple tax report, just a 1099, and it didn't have a stack of papers this big you had to read through to sign. It was what we've always say around here: how do you make it simple and elegant for your clients? It was roughly 6 years ago. I was at an event, and you've met Bob Rice.
Yes.
Bob, I met, and I said, I need to spend more time with this fellow because he really seems to know what he's talking about. And he was at the forefront of this. He likes to use the term, and I'll steal it from him, and we can all use it: democratization of private assets. And what he means by that is now people call them, our sort of Main Street families across the United States, Canada, and frankly anywhere else in the world that don't have 25 million or 50 million or more institutions or ultra high net worth families. They now have access to this asset class. And Bob led the charge. And that's who we actually hired as our first consultant, so we can figure out the simple and elegant solution for our clients.
Well, that makes perfect sense. Now, our audience here, and many of them are, in fact, One Capital clients, I think they're going to be interested in your perspective on this whole topic. And before we get to our three specific questions that we're going to ask today, I think it would be a good idea if you could just take a couple minutes, maybe a little bit more, to briefly discuss the case for alternative investments from the perspective of the clientele that you just described across North America.
Okay. I will try to keep this thing down to about 2 minutes, but it as with any investment theme, we look at it, and typically they derive from demographics. We talk about the aging of America. Frankly, it's the aging of developed nations: Western Europe, US, Canada, Japan. The aging of developed nations is one of the key things that's driving some of this need. And what I mean by that is, as people age, they produce less, yet all they do is really, to be fair, consume. They're not out.
They're living longer too. If I would chime in on that one, Pat, people are living longer too.
They're living longer, so that creates a longer time horizon, which works in two ways. One is they're consuming for a longer period of time. The other side of it is, how do we make sure their money lasts that longer lifespan or life expectancy? So it's a double-sided or double-edged sword in terms of a challenge for us. So the first part is demographics lead to slower growing economies, slower growing economies in the developed world mean lower expected returns on investments like traditional stocks. So we realized we've got to find higher returning asset classes and to be able to bring those in a simple and elegant way and effective way into our client portfolios. And that's where we led to this evolution, because we need higher returns to last a longer time horizon as well for our clients.
Pat, that was a great explanation and well done. Okay, why don't we get to the today's topic, the 3 questions you should ask before investing in alternative investments. And again, Pat Bowen is the president of One Capital Management. He's our guest today. Pat, as he explained, has spent well beyond 5-6 years or so exploring alternative investment space. And so, Pat, let's look at the 3 questions. Again, these are being really asked from the point of view of an existing One Capital client. Let's just look at it from that perspective. So question number 1, assuming that I have at least $1 million of liquid investable assets, what would be an appropriate allocation to alternative investments? And I guess you could add to, is there some sort of a formula as how that's determined?
There is. It's a combination of, let's call it a formula, like an engineering formula, mathematically. And then there's also the softer side of it, because everybody behaviorally might be a little bit different. And it's going to be largely driven by the need for return. So how much additional return does a client need to earn off of their investment portfolio from their capital that we're allocating? And what's that time horizon? So we have come to a conclusion that if you want to think of it as sort of neutral position, is somewhere between 5 to 10% in alternative investments, carved out of your traditional stocks and bonds. Call it bonds and cash, if you will, for that other asset class. Carve out of there and allocate to private equity, private credit, and real assets like real estate, infrastructure, commodities in general. And we like to actually keep it simple when we're in the private asset space. So it's going to start with about a 5% allocation. We might increase it up to 10, and that's probably normal for your traditional, and I'm going to use your example, $1 million of investable asset client. Liquidity constraints, how much they need to distribute on an annual basis, is going to be another factor that goes into it. And longevity, time horizon. When we bring all those together, maybe those lead us to think 15 or 20%. We personally would think that going above 20, probably not wise for individual investors if they're in a liquid asset household of $1 million to 10 million, maybe even 20. So anything above that, now you become almost quasi-institutional, and maybe you stretch from that 15 to 20 or 25 allocation. For most households at $1 million and change, 2 million liquid assets, you're looking at probably a 5 to 10% allocation.
I guess you would refer to that, if you refer to that segment of the population, you call those accredited investors, essentially. So I think, if I understand correctly, and you can correct me, you wouldn't be the first time, that I believe that this program is intended for accredited investors. Is that correct?
Yes, absolutely. They have to be accredited investors.
And the definition, I believe, of accredited investors, and this is applicable, I think, in the U.S., is they have to have at least $1 million of liquid assets. Is that the sort of the bar, the line in the sand from the perspective?
A little bit. It's $1 million of net worth, excluding personal residence, or 200,000 of income for the last 2 years for an individual, or 300 for a couple filing jointly. Now that's a U.S. thing. Canada, by the way, the numbers up north are just about the same, but we know nobody files jointly in Canada. Everybody's still filing individually.
Right.
So those are the numbers. Million of net worth, 200 if you're an individual, 300 for a household.
So in theory, someone who's earning a higher income, will say, 300,000, 400,000, whatever, and they didn't have $1 million of liquid assets or $1 million above their real estate, they could potentially qualify as well.
They would still be qualified. Yep.
Okay. Yep. Good to know. Now, again, I think we talked about this before, I know you and I have, is that the idea of adding, stock and alternative investments to a classic stock and bond portfolio, it has the ability to enhance risk-adjusted returns over the long run. right? So I think we both agree that's the whole principle, and that's why we're proceeding about this. So would you agree that, say, for a classic 60-40, which is considered, I guess, in our world, a balanced portfolio, a starting point of 5% would be reasonable?
Yeah, that's exactly where we are. And that's what we're recommending right now. What we're doing for our clients is the 5%.
And again, the key motivation here is what we're trying to do is we're trying to enhance returns without doing so by increasing risk level. So the risk tolerance of the client would remain the same. We're just trying to get a bit of more boost to the returns.
Yeah, and the private assets world is what allows us to capture that. And if you look at private equity, just ballpark in general, expected return, and this is just for basically being in the median, right around the middle of the universe of private equity, the expected returns around 13, 14% annualized or compound return. For traditional large company, domestic stock, or developed market stocks, US, Canada, Western Europe, Japan, the expected return is around 7 to 8. So you can see that it's a significant increase in expected return. And that's what enhances the return. We capture that opportunity. But because in the short run, they may behave differently in terms of their price movement, it smooths out the client's experience in terms of their pattern of return. It's, you know this, Wayne, this is the thing that we've always tried to seek out and do. How do you enhance return and manage risk or reduce risk? And this is one of the best options for us to do that.
Yeah. This is I really appreciate the response and the perspective here. And, as an advisor of, One Capital Management clients, I think, this is a great idea that we're putting forth for our clients. And, one of the questions I'm getting, though, I will tell you, we've started to notify clients that this is a strategy we're going to be employing. One of the questions I'm getting, though, is how can I be, and this is question number 2, by the way, of our 3 questions, is how can I be sure that these investments are going to meet my investment objectives?
Well, look, I'm going to be totally fair. And I know our compliance officer down the hallway would be really happy when I say this. There is no sure and absolute with anything. Frankly, we can't be absolutely certain of the return we're going to make on NVIDIA over the next year or 2 or 3 or 5.
Yeah, no kidding.
No matter what it is, there's always going to be some element of risk to it, especially in the world of equities. But what I would say is the best way to assure yourself, let's call it a much higher probability of success, no matter where you're investing. We've got a lot of smart people on our investment team, but we knew we also didn't have the expertise. You mentioned it earlier. I don't have the expertise per se, but I have the education now to have an understanding. And one of the first things we understood was you better find somebody to partner with that has the experience and the expertise that they've developed over time, and you can observe how well they've done over time to find the best partner to bring to bear for your clients. We're very fortunate in that because we, after an extensive search process, consultants all over the country, other investment managers in the private asset space, we landed with Wilshire, who's been in business for over 50 years. They've been advising institutions all over the world, from sovereign wealth funds to California Public Employees Retirement System and everything in between, and 30 plus years of doing just private assets. And we were able to partner with them, hire them, if you will, to be our guide, our counsel in terms of allocating to private assets.
Just as an aside, I think one of the most compelling, we had a meeting with Bob last week, and one of the compelling points that he made that kind of raised an eyebrow for me was the fact that 87% of companies, I think, with revenues over 100 million are not publicly traded. 87% are not. That was, to me, an eye-opener. That was
it is a remarkable universe
that we have
companies.
No clients typically have not had any access to.
Well, I'll share one other. This is my other favorite part of this. Is it now companies stay private longer. Probably because they don't want all the headache of being a public company is one of the reasons. But the average amount of time before a company does an initial public stock offering to offer their stock on the exchange has gone from 4 years, just about 30 years ago, it was around a 4-year private incubation period, to today it's 12 years on average. And they went from an average IPO of 500 million to 2.5 billion. So I think of it this way, that $2 billion delta was the enterprise value or wealth creation that went to the private enterprise owners. And so part of this is we want to participate in the world of private enterprise ownership to some small degree. And that's why we're allocating 5% at the start to own the wealth creation and participate in that for our clients.
All right. Well, it makes perfect logical sense to me. And again, when that point was made, I must admit that that was an eyebrow raiser, at the minimum. Okay, so question number 3, Pat. And again, this comes from the view of an existing One Capital client. My biggest concern is liquidity. If I decide to allocate a portion of my portfolio to alternative investments, how easy will it be to liquidate or to receive, income distributions on a regular basis?
Okay. There's a couple pieces to that, so let me separate them.
Sure.
The first one is the notion of the income distributions.
Yes.
Remember, we're talking about, in particular, on the private equity side of the portfolio, which for our fund here with Wilshire, 60% of the money is in private equity. Assume this way. Don't expect any dividends are distributed from private companies. They are plowing their money back into research and development and growth. That's their objective, is to grow the business. So we wouldn't expect any distributions until a company is ultimately sold or IPO'd, one way or the other, it's a sale. And then all of that wealth creation is now captured and realized, and then it'll be distributed to shareholders of the fund. The other side is the income. So there's some private credit, which we've had exposure to for several years now. That has a pretty high yield. That's about 20% of this fund. So roughly, if 10% is the yield on that, there's about a 2% yield overall on the fund. 20% times 10%. Then on the infrastructure, there is also some income that is derived. Not a lot, not significant, and that's not why we're doing this. Clients would have their traditional fixed income allocation for the income and the ballast of their portfolio. They have their traditional equities, which are now more mature. They're driving a lot of free cash flow. So think of your Apples or your Chevrons or whatever it might be, and they've got profits distribution in the form of dividends. Overall, it's roughly 2% for the publicly traded markets. Then you now have this private equity and then the infrastructure or real assets. Think of that as a longer duration investment. You're going to recoup your investment plus appreciation over time, and it's going to be a little bit longer time horizon before you do that. So keep that mindset, is what I would say. So the time horizon, when you think of just this small little 5% slice, needs to be thinking longer. A little bit longer than we are for our traditional stocks. Let's call it that. Okay, so that's one piece. Now, liquidity. The fund is already set up and structured so that there is monthly entry points, and then there are quarterly exits. And the quarterly exits, just similar, very, very much similar to our private credit exposure we've had for a couple of years now, is limited to 5% of the value of the fund on a monthly basis. Now, the fund itself has a couple of mechanisms. It has access to cash and then also other liquid investments in the portfolio and a line of credit if it needs to meet those demands. And the portfolio managers, Wilshire, doesn't want to sell a company in the portfolio. So they can meet demand for somebody who wants to trim part of their holdings, which, as you know, we are regularly rebalancing our client portfolios.
Exactly. Yes.
So we're going to have to be doing the trimming here to trim our private equity down a little bit. It's going to outperform over the long run, We've got to trim it and then reallocate back to traditional stocks and bonds and keep that overall portfolio balance and integrity. There's one other mechanism to it, which is actually a very unique feature of this fund. And it's one of the things that Bob Rice worked on. Bob is an attorney by background. He's lived and worked in Washington. And Bob knows the folks, and it's not just Washington. You've got to work with the SEC, but you've got to work with the markets, including the NASDAQ. There is a NASDAQ secondary market for private assets like this. So we can match up some of our theoretically sellers to other buyers, and they would be able to buy the fund direct from our clients if we needed to liquidate. So there is that extra feature of liquidity that is not normally available in private assets.
It's an important feature for our clients, and actually as a part of our rebalancing process.
Exactly.
Again, the key thing for us is that, we like, we're not a tactical shop, right? We're more strategically focused. So we like to maintain these allocations that we have recommended for our clients. So that will allow us to make that happen, and super important for us. And because again, when I do my quarterly reviews, Pat, I'm always pointing out the importance of the allocation, whether it's a 60% or 70 or 80 or 40% equity exposure, that we maintain the integrity of that over the long run. So this additional liquidity feature will allow us to happen. I do have one additional question. I know it's the 3 questions podcast here. That's what we kind of promote, but I've been called out on this a few times actually by my guests. So pre-warned here. I have one additional question. I think it's relevant for One Capital clients, and our clients are now going to have the ability to participate and add alternative investments to their portfolio. What are the plans to offer our Canadian clients, either Canadian clients that have U.S. investments or Canadian clients with Canadian-based accounts, which, of course, one of the unique things about One Capital Management is that we're managing clients' accounts in both countries. So what's the plan going forward if you're a resident of Canada? Will you have, if and when you'll have access to alternative investments?
Okay. So again, I'm going to split this one. And by the way, I'm going to let you have this one because I'm going to call this question 3B. So it's still technically part of the third one. So I won't get you in trouble.
Always gives me the hall pass. Thank you, Pat.
So 3B, though, I'm going to give you 2 pieces to the answer because I'm going to start with first a Canadian resident, but they have U.S. assets.
Correct.
And as you know, it can happen in many different ways.
It's mainly IRAs as a typical.
It's mainly, you're right, registered or IRA retirement money.
Yeah.
Here's one of the other interesting, because this fund is structured as, I don't want to get too legalese for folks, but 1940 Investment Act fund. It's right. Registered investment company fund. It is allowed to be invested in or owned in a retirement or registered account, U.S. So that is wonderful. So our Canadian resident clients with registered or retirement money in the States, we can actually invest in it in the United States through that retirement account.
Okay.
That's already free and ready to go. In Canada, for their non-registered money, let's call it, their individual accounts or joint or trust accounts up there north of the border, custodied with a Canadian custodian. We're working through the mechanics of that right now. We've actually found in the prospectus of this fund that we just have to make one modification, which we'll circle back to probably the end of April. And I would expect that before the summer is over. I won't promise this, and I won't promise that I'll give away my children for this one, but I have high expectations. By the end of the summer, we will be able to directly invest in this fund for our Canadian non-registered client money.
Would it be, do you see, and again, nothing like putting the president of my company on the spot here, but between friends, right, Pat? So what is the probability for those clients to have large RRSP or RIF accounts? Do you see any potential path forward where they could also be eligible?
I think so. Sorry to cut you.
No, you're good. Yeah, you answered. You're there.
I think, and I left out registered. I think we will be able to include it in registered accounts at the same time. And one of the key pieces is we're working with our custodians in Canada, and they have been wonderful in this process. And it just started the conversation with them we did about 2 or 3 weeks ago. Hey, why can't we do this in Canada? Now, there's another way to do this that's a little more complex, but we think we actually can do it direct into this one US-based fund and not have to worry about any other mechanics other than we will modify the prospectus to include, this is not my word, I don't think it's appropriate, but foreign investors. That's what the language would have to be in the prospectus. And then we can do it for our Canadian-based clients.
Interesting. All right. Well, there's hope because as you know, we have clients that are in Canada that have some pretty significant assets in their Canadian retirement accounts that may say, hey, what about us? Right. So excellent. Perfect. Pat, what can I say? I really appreciate you making time for me. It was kind of last minute here, and appreciate you making time for us. Today, our guest was none other than Pat Bowen. He's the president of One Capital Management. Pat, thanks for the time. Appreciate it.
Wayne, thank you for having me on the show. I hope I'm invited back one day.
I would love that. I have a couple ideas of topics I'd like to cover with you, but we'll take care of that off camera. You take care and enjoy the rest of your day. We'll talk soon.
Thank you. Take care.
I look forward to bringing you the 3 Questions podcast, and I hope you find them educational and informative. Please consider liking and subscribing to our YouTube channel, and to receive notification of when our latest episode will be posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and see you soon.